When you trade options on a stock, like, say, NVIDIA, you're betting on a real company, its products, its leaders, the whole thing. But what if you could trade an idea, an emotion? Well, that's what we're talking about today. We're diving into the world of VIX options, where you're not trading a stock at all. You're trading fear. All right, so here's how we're going to break this down. First, we'll get into the whole idea of trading fear versus trading ownership. It's a big mental shift. Then we'll get into the nitty-gritty, the core rule differences you have to know. After that, we'll tackle the VIX pricing paradox. This is what trips up everybody. Then, the fun part, a real case study of a winning trade step by step. And we'll wrap it all up with a big strategic takeaway for your portfolio. Okay, first things first, we kind of have to rewire our brains a little bit here. Because equity options and VIX options, they're playing on two totally different fields.
I mean, think about it. An NVDA option, it's tied to something you can actually picture, right? You can imagine the chips, the data centers, the financial reports. But a VIX option, what's that tied to? It's tied to a calculation, an index that just measures what the market thinks volatility will be in the next 30 days. So you're not betting on a company to succeed or fail. You're betting on how anxious the market's going to be in the future.
And because the whole idea is different, the rules of the game are massively different too. And let me tell you, understanding these rules isn't just a suggestion, it's absolutely crucial if you want to trade these things successfully.
So let's put them side by side. We'll use a regular old equity option, like for NVDA, as our normal example. And you're about to see just how weird and interesting the VIX really is.
All right, buckle up because this is where it gets wild. First up, the underlying asset. You can buy NVDA stock, right? But you can't buy the VIX. It's not a thing you can own, it's just a number. And that leads to the biggest difference of all, settlement. When an NVDA option settles, you might get actual shares. VIX options? Nope. They're cash settled. The contract literally just vanishes, and cash, either a profit or loss, shows up in your account. That's it. Then there's the exercise style. NVDA options are American style, which means you could get assigned shares pretty much anytime. That's a risk. VIX options are European style. They only settle right at expiration, so no early assignment risk, ever. And this one's huge. What drives the price? For NVDA, it's performance, right? How's the company doing? But for the VIX, it's all about mean reversion, this idea that volatility always snaps back to its historical average. And last but not least, even the timing is different. Your regular option expires on a Friday afternoon. A VIX option, it settles on a Wednesday morning. Totally different rhythm.
So that brings up a huge question, right? If you can't trade the VIX itself, then what on earth is driving the price of its options? This is where we get to the VIX pricing paradox, and honestly, it's the #1 thing that confuses new VIX traders.
And listen, if you only remember one thing from this, let it be this. VIX options do not track the spot VIX you see on TV. Let me repeat that, because it is so important. The price you see for your VIX option is not following that VIX number flashing on the news. So you might see the VIX spike to 30, but your option that expires in 6 months, it might barely even flinch. So why is that?
Well, here's the secret. Instead of tracking the spot VIX, these options track the VIX future that corresponds to their expiration month. It's all about what the market expects volatility to be on that future date, not what it is right this second.
And this whole looking into the future thing often creates a situation called contango. It sounds complicated, but it's pretty simple. It just means that even if the VIX is super low today, the futures market might be pricing in a higher VIX for, say, 6 months from now. Why? Because the market just expects things to eventually get back to a more normal, a slightly more chaotic level of volatility. It's always pricing in that eventual snapback.
Okay, that's enough theory for now. Let's make this real. We're going to walk through an actual VIX put trade from start to finish so you can see exactly how all these weird rules come together to make money.
So the bet was really simple. The idea was this. Fear in the market is going to calm down and subside by April 1st, 2026. That was the whole thesis. And in the world of options, how do you bet on fear going down? You buy a VIX put. So here's the exact setup. The position was long 2 contracts. The option was a VIX 27 put. And the expiration was way out on April 1st, 2026. The average price paid to get into the trade was just $1.01 per contract. Now remember, each option contract controls 100 units. So at $1.01 each times 2 contracts, the total cash put on the table, the absolute maximum risk for this trade was just $202. All right, now let's fast forward all the way to settlement day. Remember, it's a Wednesday morning. And here's the thing. There's no sell button to hit. There's no decision to make. The fate of this entire trade is decided automatically by this special opening auction that sets the one official settlement price. And that morning, the magic number came in, 25.02. That's the official settlement value. They call it the VRO. This one single number is everything. It's all that matters to figure out the payout. So how do we get from 25.02 to actual profit? Let's walk through the calculation. Step 1, we figure out how much in the money the option is. We just take the strike price, which was 27, and subtract the settlement price of 25.02. That gives us $1.98. Step 2, we figure out the gross return. We take that 1.98, multiply it by the standard 100 multiplier, and then by our 2 contracts. That gives us a gross return of $396. And finally, step 3, we just subtract what we paid to get in, that original $202. And there you have it. That initial $202 investment turned into a final cash value of $396. The net profit? $194. That's nearly 100% return on the cash risked. And the best part? It's cash settled. That profit just appears in the account. The VIX position itself, it's gone. Poof. It's an incredibly clean way to trade. So what's the big picture here? What's the so what? Why would a trader, especially someone with a portfolio full of tech stocks, even make a bet like this? This is where we get into strategy. And here's the most important strategic point. This was not a hedge at all. In fact, it's the exact opposite of a hedge. A hedge is like insurance you buy when you're scared of a crash. This trade, this was an offensive play. It was a bet on stability, a bet that the market was going to calm down. You could call it a confidence play. And that really sums up the whole goal here. For a portfolio that's heavy in growth stocks, stocks that tend to do great when the market is calm and stable, buying VIX puts is a way to express that bullish confidence. It's a way to squeeze some extra profit out of a stabilizing market. All right, so let's wrap this up with the key takeaways you absolutely need to remember. 1. VIX options settle in pure cash. No shares, no fuss. 2. They are European style, which means zero, and I mean zero, risk of early assignment. 3. They let you trade a concept, an idea, the market's fear itself. And 4. The whole position just disappears at expiration and the cash shows up in your account. It's clean, it's simple. You know, it's a totally different way of thinking about the market, right? You're moving beyond betting on specific companies, and instead, you're trading the overall sentiment of the entire system. And that leaves us with one final question for you to think about. When you're feeling good about the market, when you're feeling confident, is your portfolio actually set up to profit from that stability?